Good morning, everybody, and welcome to Beat the Bell, presented by Kane Capital. It's awesome to have you guys join us this morning, the morning of NFP. That's starting to move the market. Last night, the S&P futures were down about 20 points, now up about 15. It's going to get interesting. It's been a very volatile trading week. Yesterday, we saw a 100-point reversal intraday in the S&P, closing down 1.84%. Now, to talk about what we have in store today and moving forward into what will surely be a busy day in the markets, we've got an awesome panel with us, starting with Money Mander. Mander, good morning to you.
Good morning, Alejandro. Happy Friday. Crazy week's really been the Wild West as we had Jerome Powell shift some narrative this week, and NFP today. We'll cover that in a second here.
All right, Diamond Trades.
What's going on, guys? Happy Friday. As Mander mentioned, this was one of the wilder weeks in terms of news, and so we have a little bit more to cover, but it's coming to an end. Should be a good one.
All right, Moe Mamba.
Good morning. So NFP's out, huh? Excited to hear from Mander and Diamond about it. Let's get it.
All right, Stock Snipa. Ramsay Rippers.
What's up, guys? Happy to be here. Yeah, crazy week. We got NFP today, just dropped. CPI next week as well. So it doesn't end, baby. The party is just getting started.
All right, and last but certainly not least, our special guest, who is kind enough to join us this morning, one of my great friends, Markets and Mayhem. Mayhem, good morning, man.
What up, Alejandro? Great to be here with everyone today. What a interesting data print. We'll get into that in a little bit. And what a tumultuous couple of weeks we have ahead of us. You know, we've got CPI next week, as mentioned, but we also have options expiration, volatility product expiration the week after the Fed.
Yeah, there's certainly a lot for the markets to still learn in the next few days. All right. Let's jump right into Fed forecast, economic outlook with Diamond, Mander, and Mayhem.
Yep. So let's just go ahead and dive right into the breaking news that we just had with the non-farm payrolls print. So Ryan, if you want to throw up the expectations graphic for basically what they were expecting for this month, we had expectations for this one come in at about 225,000. The non-farm payrolls came in about 310,000. It's a little bit hot. Hotter than expected in terms of the jobs added to the economy. This, again, comes after the 517,000 that we added in January, so 2 consecutive hot prints in a row. They were also expecting average hourly earnings increase of about 0.3%. And if we check on that number also came in about 0.2. So it came in a little bit light. You like to see that. That's a measure that the Fed watches. Obviously, as those average hourly earnings increase, you're gonna have upward pressure on inflation. So they it's welcoming to see that number come in a little bit light. But yeah, that's more or less the data today, and the market really hasn't moved a ton. As Alejandro mentioned, we sold off aggressively yesterday, that 100-point reversal intraday, sold off another 20 points in after hours. On the print, we sold off about 20 points, rallied about 30 points, and now we're kind of just trading flat. I would love to get your guys' take on this print. What are you guys thinking? We'll start with Markets and Mayhem.
Sure. So I think it was a pretty interesting print. The job gains were led by leisure and hospitality, retail, trade, government employment, and professional and business services. It was quite a bit stronger than expected. Not the insane beat that we saw for last month's data, but still noteworthy. And unemployment also ticked up just a little bit. But the big picture in the job situation remains this. JOLTS data also came out earlier this week, and there's still about 1.9 jobs available for every person seeking work. Now, you could say from just looking at that in a vacuum that we've got this very tight labor situation, and you do if you're only factoring for people that are actually in the workforce or seeking work. But there's also a rather high, even generationally high, amount of people that aren't participating in the workforce. And that labor force participation rate remained pretty low, even with this strong NFP print. So that's just telling us that there are still a lot of people kind of on the benches, whether they retired early, whether they're sort of in the gig economy or working, outside of the purview of the what is captured by this data set. It does suggest, as Powell has hinted as well, that there's still plenty of folks that could potentially rejoin the labor force if conditions warranted it.
And Mander, I want to get your take on this as well. I'm also seeing that we have Fed futures basically pricing in what they've dropped the expectations of a 50 basis point hike in March down to under 50% from what was it at, like 70s, 80% earlier.
Yeah,
this week,
upwards
right?
upwards of 80 as of yesterday morning.
Right. Yeah, they've dropped those odds down to under 50% for a 50 basis point hike at the March meeting. What are your thoughts there?
Yeah, well, really what I'm seeing from this, I think the markets today at least are going to be battling with, you have the downside of non-farm payrolls coming in hot, but we also finally are seeing unemployment rate uptick, and albeit by 0.2%, it is finally moving in the direction the Fed is wanting. We're seeing manufacturing payrolls come in negative as expected after the ISM manufacturing numbers, the Dallas Fed manufacturing numbers. That seems to be the sector getting hit the hardest, where private payrolls came in really hot. I think, as Mark Mayhem noted, with leisure and hospitality, those are the ones leading. I think the great point that he made as well was, as we had a lot of people retire early post-pandemic with the whole wealth bubble created, I think as people start to re-enter the workforce, it's going to keep that unemployment rate low, as people have to come back into work and eat up those vacancies that he said. There's 1.9 jobs available. So even as people return to the workforce, there's plenty of jobs available for them as that wealth bubble kind of saturates and dissipates with the monetary policy hikes here. So that's kind of what I'm watching. I think this unemployment rate, it uptick by 0.2%, but how long does it really take it, and how much hikes does it take to really get it to that point that the Fed's looking for? And I'd love to get his take on that as well. I think that's what's really going to lead to this sticky inflation going forward for the foreseeable future.
Yeah, I think that's a good point to consider. And there is some signs that services inflation is remaining pretty sticky. That tends to feed into wage inflation, which again tends to then feed back into services inflation. So it does become a bit of a negative feedback loop, if you will. And, the Fed's goal, and no one envies the job of the Fed here. Let's be real. The Fed's goal is to not crash the economy, but also try to make sure that this inflationary pressure becomes more subdued. They're walking a literal monetary policy tightrope. If they lean too hard in either direction, unforeseen and nasty consequences could manifest themselves. And so they're trying to do what they can do with a very limited set of tools. And let's be clear about this. The Fed cannot do anything for the supply side. That's really the job of the legislature, and they've been fighting the Fed for some time. So it's fair to say that even though the Fed is adamant about wanting to take the only tool they have, which is tantamount to a sledgehammer, and take it to the patient here who's sick and say, here, we're going to fix your broken leg with this hammer, it's not exactly going to work out as we might hope. And I think that the problem here is that we don't have the kind of expansion of supply that we need. We have, as we can see here with these numbers, a lack of supply in labor, but we also have a lack of supply in real world commodities. The production and exploration in oil and raw materials, and then the production of agriculture, are just not there, so that if we do get back to a new credit cycle, inflation could come back pretty early on. It's become structural in nature because of these deficiencies. We've kind of gone from an era of abundance in so many things, even including capital to the list of the things I just mentioned, to an era of scarcity. And that's not something that's set to end unless and until these things are resolved. And as we can see with some of the interactions we had between Chair Powell and legislators, they're still kind of flying blind. They don't seem to be really getting the picture here that the only way we fix structural sticky inflation for the long run is by expanding supply. We need to go back to some of the economic policy ideas of the 1980s here and really start to look at it from the perspective of how do we make sure that this intractable sort of Gordian knot of structural inflation can be untied one bit at a time. And it's going to require some coordination. But until that happens, if it even happens at all, the Fed has to continue to go kind of heavy. And you mentioned the Fed funds futures. I thought I would just zoom out a little bit on them. We've taken out the idea of 5 3/4 now. Now the Fed funds futures are showing a peak terminal rate of about 5.5%. And they're also looking at a cut This is just this morning, but as early as November of this year, when just a couple days ago, it was January of next year. So, expectations are shifting in real time as we see this data come in. And I think it's pretty important to take into consideration that the Fed's job is nowhere near done. The idea of a near-term pivot or major policy framework change, that's something out in the distant future. I don't think we're going to see QE come back possibly for years. And the rate cuts we do get will probably keep us still at a somewhat elevated level when we do start to see them, whether it's later this year or early next year. And with all of that happening, there's this sort of cumulative tightening, right? We have this effect of all these small and mid-sized businesses who have revolving lines of credit. They're seeing the immediate increase in the cost of doing business. So are consumers, particularly those that are levering into credit cards to pay their basic bills. But larger companies also have to take out new lines of credit and refinance. And while that maturity wall isn't out till about 2025, still every single day we have these higher rates, more and more parts of the economy are being impacted. And we've had this sort of offsetting effect, if you will, from liquidity from the Treasury General account, from the Bank of Japan, the People's Bank of China. That's helped to levitate asset prices since October. That's helped to put people back into more bullish animal spirits. But a lot of those effects are beginning to diminish. And now we'll probably start to see the real tightening impact, that drop of liquidity. And we're seeing for the first time really since the Great Depression that money supply has gone negative year over year, which is a pretty big deal because it means there's less money to lend. There's also less money to pay back loans. And that kind of gets us into the situation we're starting to see with some of these banks.
That'll be great to cover with SIVB, which we're going to hit on in a second here. But Ryan, if we could pull up this chart of supply and demand, I wanted to cover this really quickly because I think this is a fantastic point that you brought up. So pre-pandemic, we were pretty much sitting at point C. And then with the global lockdown, with the pandemic and the closing of all the supply chains, manufacturing, logistics, we immediately shot up to point B. And you can see that's already half the inflation battle. And so then as we had fiscal policy come out, quantitative easing, ZERP, that really sent us to point A where we seem stuck at. But even so, moving forward, all the Fed has at their disposal is to bring us back to point B and destroy consumer demand. Until we get some type of fiscal policy or expansionary policy to really help the supply side, this is going to be extremely sticky moving forward. And so Fed fund futures aside, if I was going to place my bets, I would be betting with the monetary policy predictions that the Fed put out, which would be no pivot in 2023.
I just want to also add one more thing to that. We're going to get an update to that, from the Fed meeting coming in just under 2 weeks. And I think that's going to be very important. I think you're right in the sense that not only do we see expectations shifting, but probably to a higher upper bound terminal rate. In December, those expectations from SEP were about 5.1%. I'd expect they get up to about 5.4% the next meeting on the dot plot for that peak upper bound terminal rate.
100%. And I think, you kind of touched on this a little bit, how this past month in particular, it really seems like the market is sort of playing catch up, right? With how they're pricing in where the Fed is going to go with this terminal rate, right? They started out sort of behind the ball in January, pricing in aggressive cuts really towards the end of the year. They realize that they're off sides and they drastically shift their expectations, almost like a knee-jerk reaction. You have an 80% chance of 50 bips next month. This is literally like on Monday. Like this just happened. Like 80% chance of 50 bips, no cut, terminal rate priced in at 6%. Now this print comes in, and we're back below 50% chance for 50 bips in March. There may be, as Marcus Mayhem said, looking at a cut out into November, December. So to me, what it seems like is this market is very, very hungry for some sort of certainty, right? And I think that Jerome Powell may be able to provide that at the meeting coming up in just a couple of weeks, as Marcus Mayhem mentioned.
Well, let's hope that we get original Powell and not whoever came out in that February press conference, because I didn't even recognize the man at that press conference. The sort of things he was saying were so completely a departure from the tone he had set from Jackson Hole on. And then we got some of that original Powell during the testimony this week, didn't we? He came out more fire and brimstone, more hawkish, higher for longer, or higherist for longerist, right? Is sort of the mountain of rate hikes and policy tightening that the Fed has really committed itself to. And I think there's just a little bit of latent frustration with Powell, not just with how the market's behaving, but with the fact that he feels like his mission has become this much harder with so many different forces converging to fight the tightening effects of the Fed.
Right. Great points. All right. That'll wrap it up for us here on Fed Forecast. Let's pass it back to Alejandro.
Phenomenal, guys. Thank you very much for that. All right, let's go straight into Bet the Bell with Ramsay Rippers. That's going to do it for the system. I'm going to pass it over now to Ramsay Rippers for Bet the Bell. Good morning.
Good morning, guys. All right, guys. Good morning. Another great segment. Ready to do it. Excited with the special guest. And happily today, finally, we have the updated stats for the green or red question. Let's get right into it.
Oh! Screenshot.
Digest it.
There it is. Most wins all time. If that, I mean, it's at least a sign of effort, right? I mean, I'm here.
For sure.
I'm a winner. The win percentage obviously isn't up there yet, but
bronze
I'm
medal,
making a push.
Bronze
Look,
medal, sick.
We've been talking a lot about, Hondo and Diamond as far as, the two leading wins, and we keep skipping out on 12 wins, 18 loss Moe Mamba. I mean, thank God. Thank God. All I'm going to say is thank God his trading is completely the opposite of his green or red guesses. You're
Thank God you brought up that point, because I was about to tear you on Beat the Bell, my man. You're calling me out like that. That's good you brought up that point.
I mean, all I'll say is this guy's probably the hottest trader on the team. I mean, continuously winning.
Yeah, I don't really get that. That one doesn't make sense. I mean, you don't lose any trades, but you can't. I mean, it's like you're executing, but you're not. I don't know.
Guessing
Work
direction.
on it, Mo.
Yeah,
you can follow me today.
Let's get right into it. So, as the guy stated, U.S. Bureau of Labor Statistics revealed that non-farm payrolls rose by 311K. What was it, 205 or 225 expected? S&P 500 is down about 150 to 160 points since Monday's high. We basically tested 3,900 right before the close yesterday. I believe the lows were 39.08. Market bounced a tad off this NFP data. Luckily, not too much of a bounce or dump. We can still, we're in a valid range as far as green or red. Market's not even up 0.5% point. Market's up about 1/3% right now. Let's get right into it. Green or red today. Let's start off with markets and mayhem. What do you got?
Yeah, so I think there's a decent chance that we could have a green day here. I don't know if it's going to be a big green day, but it is Friday. Fridays typically tend to be decent days, and we are in a seasonally strong time of year. So let's see how this thing opens. But pre-market so far, I think that people are liking this higher unemployment rate, as sad as that is.
I like that as well, especially on the technical standpoint, as far as where we're trading on the chart, 3,900 big level. I could totally see it getting bought back a bit today. Mander, what do you got?
As sad as it is, they definitely are liking the higher unemployment, but I have a feeling Diamond is going to go green. And so I'm going to say red. And I think this is met with some exit liquidity at the open.
Guys, come on. We can't just be doing it because of the stats. I want the truth. I want what you really feel.
Something's got to weigh me with one side or the other.
Diamond,
This is like Inception, dude. Like he thinks I'm going to do this, so he's going to do this. I'm going to take red, actually. I'm also going to go red. I think it could go either way, and I definitely get markets mayhem point. But I also could see, like Mander said, them rallying this at the bell, grabbing a little bit of exit liquidity, and absolutely dumping it into the weekend. Could totally see it.
Hondo.
So I'm going red because here's my issue. Right now, the 200-day moving average on the ES futures, the S&P futures, is sitting at 39.50. We popped up here to, what is this, like 39.42, stalling under it. I think that we sell off from here. I mean, there's massive, massive resistance. Guess I'm going with Diamond. Diamond, you said red, right?
Yeah.
Dude, I mean, I'm not helping myself out by picking, but I mean, I got to go with my gut.
Yeah, 39.40 on SPX as well. I'm not sure if you stated that or ES, that 200-day. Mo.
I'm gonna go green here. I'll elaborate more on that on the analysis, but I'm praying green. You know me, guys. I have a handful of positions. This is the first time in a while I only have 2 positions. They're both short, right? And I've trimmed most of them, but I need this to come back up so I can load more shorts and get new lows on this market.
That's what's up.
Yes, let's get it.
Yeah, I mean, I could also see it chopping around, waiting for CPI. I mean, after this huge move this week, I mean, you look on the daily, It's a 160-point move off of that Monday. I mean, it was over 100 points intraday as well yesterday.
Dude, yesterday, 40-50 to like 39-30.
The one thing I would say just going into today, we've got the dollar down. We've got bonds really well bid. I think that's going to play a little bit of a supportive role for these equity markets if that continues.
Someone else talking about the dollar and yields. I see Mander smiling through the screen right now, popping those pearly lights. All right, let's get into our second question. Speaking of CPI, that's what I'm going to have the time frame for this next question. Ryan, please pull up the Amazon chart. So I wanted to know if Amazon cracks $90 today. Obviously, we have a little bit of a revision intra-show, should I say, just due to this gap up. Amazon now trading in the pre-market 93.50. So I was going to ask if you guys think that this $90 level cracks today into that 89.87 gap fill, basically $90 on the daily. We're going to switch it though to Tuesday CPI print. I believe Tuesday at 8:30 is CPI. So do you guys think that this Amazon cracks $90 and this gap fills by Tuesday? Diamond, what do you got?
I will go. Yes, I do. I do think that it cracks. If we're gonna go like by the end of CPI day, like
excuse me, my bad. Well, let's do Monday at the close because I feel like
yeah. I'm still gonna go yes. Yes.
Yeah, today and Monday's price action. If it cracks as well, that's you can kind of call it like the neckline as well. I mean, it looks like kind of a nasty head and shoulders. Not the cleanest one, but it's definitely there. Money Mander.
I'm going to say it doesn't. Maybe it does after CPI if it comes in a little hot, but Amazon's been one that actually has been showing people eager to buy. When it rallies, it's rallying aggressively. So I'm going to say that holds at least until another catalyst.
It does, and especially off of this like 92 to 90 demand zone, if we want to call it. Markets and mayhem.
Yeah, I think that Tuesday is going to be the real big decision point for this, how CPI comes in. Amazon is a company that relies on two big primary streams of income, right? They rely on consumers and discretionary spend to some degree as their e-commerce selling a lot of widgets and other stuff. And then they also rely on that cloud spend from businesses. So from a fundamental perspective, they're deteriorating pretty markedly, but they've also been marked down and they actually went back to their or very close to their COVID lows. So I think that people are excited to buy this stock, whether it makes sense or not, doesn't seem to matter. So I'm going to give this until Tuesday for it to break. So I think it'll hold through Monday.
Right. I mean, it's only trading like 12% off of its these recent lows. January lows, $81. Let's go Hondo and then Moe Mamba.
Yeah, I'll say it holds. I'm with Mander when he was talking about the relative strength that it's been showing. All they have to do is just whisper the words AI, and this thing will rocket to whatever. No, but yeah, I think it holds.
Dude, I think that's only a NVIDIA, a semiconductor thing. No, I'm joking.
Yeah, you never know.
No, you can do any company.
Bezos is working on something.
Yeah.
You'll have Salad as a service saying AI and it'll rally 20%. Doesn't matter what they do.
Yeah. Bezos is working on something on his yacht off the coast of Eastern Europe with his jacked biceps now. That's what he's working on. Hanging out with Logan and Jake Paul. Moe Mamba, what you got?
No, it does not.
Beautiful. Quick to the point. All right, last question. As the guys mentioned on Fed forecast, we're going to talk about this Silicon Valley Bank conundrum. So the shares of Silicon Valley Bank tumbled for a second day this morning, Friday morning, as we are looking at the chart right now. Weighed on the entire banking sector again on concerns that more banks would incur heavy losses on their bond portfolios. Concerns among funders and venture capitalist investors spiked earlier this week after the bank surprised the market by announcing late Wednesday it needed to raise like over $2 billion in stock. The bank was forced to sell all of its available sale bonds at $1.8 billion loss as its startup clients withdrew deposits. It said shares are down another 60%. Another 60% pre-market trading this morning. Crazy. I want to hear your guys' thoughts. I want to especially hear Markets and Mayhem, what you think about this. And as mentioned as well, Jim Cramer urged investors to buy SIVB, saying it was still cheap and has room to run. This is up there with Coin.
This is up there with Bear Stearns. I mean, this is such a terrible call. It's unbelievable.
it's up there. It's got to be up there with the coin buy at 400, and also coin was a buy at 400, and then it was too early to be a buy at 40. So this is a pretty bad one for.
I'm going to age myself saying this, but back in the financial crisis, Jim Cramer came out and said Bear Stearns was a buy, that this company was doing just fine, and this was before the company literally went to zero. And, this is just a long and storied career of him calling these things like, oh, yeah, everything's going to be fine. And I'm not saying we're on the cusp of another great financial crisis, but we certainly are repeating a trend here. And that trend is that whatever Jim says, it seems like it's almost best to fade it. You can make more money going the other way.
Talk to me a little bit about SIVB and the financial market, the financial sector as a whole, these big banks, and and a possible outlook on what we could see towards the end of Q2 as well as the rest of this year.
Sure. Yeah. So, I think that, and I was talking to my partner, Aisha, about this a little bit pre-show because she's got about 18 years of corporate banking experience. So I always like to lean into experts. And she was saying the issue was really that they had a lot of their money parked in treasury bonds. And when the Fed comes to raise rates, the value of that portfolio gets destroyed. And so they actually had to liquidate that portfolio due to the amount of withdrawals they had. That incurred an enormous amount of losses. And that's kind of why they're in this situation, because this is a bank that caters to venture capital and other very high risk areas of the market. And so there is, some minor contagion effects here. I don't think we're on the cusp of, again, another great financial crisis, but I do think we have higher levels of systemic fragility than we saw, maybe for the prior 2 years when the market was a little bit more liquid than it is now. And so when you look at the overall banking system, unrealized losses at banks, they did fall about 10% in the fourth quarter, but they remain quite elevated at $620.4 billion. And banks have these buffers that they're supposed to be able to use against losses. Those buffers are at levels we haven't seen since 2006. So they're extremely low. So I would say that if we had a bigger domino fall, then we would be at some risk. I don't think it's Silicon Valley Bank, or I don't think it's Silvergate that sets that into motion. It would have to be something a little bit more systematically important. But these are warning signs. The regional banks are not well capitalized. And going back to that fall in money supply, that's a big deal because it means that banks don't have the kind of liquidity that they need, and their clients don't have the liquidity to pay back the interest on their debt. And then think about who a lot of these other regionals are lending to. Small and medium-sized businesses and consumers, all of whom are struggling under what I was talking about previously, this idea that all of their revolving lines of credit are increasing in cost. So it's not only becoming harder to be a borrower, but it's also becoming harder to pay back your debt as that money supply decreases. So I think this is probably the first of many of these types of situations that we see. The real question is whether a larger player starts to show some signs of stress. And if we look at specifically Bank of America, and I'm not saying they're next, but their unrealized losses are the largest of the big four at $116 billion, largely in that same bond portfolio, the same things that Silicon Valley Bank was selling down. And as we got into this year, there was this big rally in bonds. There was a sigh of relief in financials. People were saying, okay, well, maybe the worst is behind us. But all those gains in bonds have been given back. And so banks are kind of back to where they were towards the end of last year, where things were looking kind of stressed.
You hit the nail on the head there. That was the one thing I wanted to bring up, was that as far as I understand, these banks post great financial crisis have to hold X amount of assets either in the Federal Reserve or in qualified treasuries and debts, correct? So if we continue to see a move here with the terminal rate going higher than expected, even for the foreseeable future and the rest of the year, as these bonds continue to get dumped, if you have bond portfolios holding 2 years at 2-3% that are getting slaughtered, could you see any realistic liquidity issues coming from the big banks like a Bank of America, a JP Morgan?
I think that there's some chance. I don't think that JP Morgan per se, they're a very well-run bank and they actually survived even the great financial crisis quite well versus their peers. But I think if you look at like the larger banks that aren't as well run, maybe these Wells Fargo or Citigroup or Bank of America, if there's a large enough catalyst, I think there could be some concerns. I don't think we're there quite yet. But remember this higher for longer mantra and the cumulative effects of tightening, which even the Fed itself has alluded to. That's where I'd start to become more concerned about how this might look, say, 6 months or a year from now. And remember, Fed policy has this sort of transmission delay of about a year, and we're not even a year out from the first hike that we saw last year. Right. So I think we still have some time for this policy to be digested. But I think the bigger risk is going to be in the small and mid-sized banks and their lack of capitalization. And that could be something that creates more issues among their peers. But for the larger banks, I still think we need a larger domino to fall. Let's say, for example, and I'm not saying it's imminent, but we did hear that there was a sort of late call from the SEC for Credit Suisse, and Credit Suisse then suspended their annual results. They're delaying them perhaps indefinitely. There are problems there. We don't know exactly the extent and the depth of them, but if that was a bank to fall, then that could certainly roil the European banking system. One other thing I wanted to note is that Silicon Valley Bank, or SIVP, is halted pre-market, down 63% on some kind of material news. The stock's currently trading at $39.24, which is about 80% lower than when Kramer recommended it.
That's so nuts. He doesn't miss. He doesn't miss ever. He doesn't miss ever.
All right, guys. Great segment. Markets Mayhem. Thank you. Let's pass it back to Alejandro here.
All right, guys. We're going to quickly go over to Moe for Mamba Market Analysis to wrap up today's show. Moe, what do we got?
I'm going to go ahead here and share my screen. It's massive. They were just infamous trend line right here. All right. SPY daily time frame analysis. Let's get this real quick. We got some time on our hands. So remember, inverse head and shoulders we talked about. We mentioned the pattern that's been playing out since the highs, right? You get the dead cat bounce, make new lows, come back, break that recent high, drop, and then you go for new lows. Same thing here. We came back up, bounce, drop, came through, broke this recent high, but fell to hold, coming through. What are we expecting? I'm expecting new lows. Will take some time, of course, but for now, what happened? This inverse head and shoulders, we had a nice break, hook and go. We mentioned into this supply zone where I will be looking for shorts, and that's what I did. I grabbed swing shorts on the indices. I did mention that we will stay throughout the week within this range. I was expecting that. Honestly, I did think NFP will take us out either to the downside or to the upside, more to the downside, right? If this ends up breaking the high, this will invalidate this whole pattern that's been playing out since all-time highs. So I would be going with the downside. Now, we did come into daily demand. We held this neckline once again here, same as we did right here on this double test right here. This is the third test of this neckline. This is why I'm saying upside. Is we did hold the daily demand, we did hold the neckline. This wasn't a strong close, right? This is a weak close. You guys know I pay attention to closes, candle closes. This wasn't a strong bounce off of this neckline. We came into it where we closed right above it, right? You could see how this candle never really got a strong bounce. Therefore, it doesn't give me too much conviction of upside nor downside. It's just I'm right in the middle, 50-50 on either way, because we did hold support. That's a case for the bulls. And then the case for the bears is we didn't close too strong off the neckline. And then we're testing this demand zone for the fourth time again. So, but I am expecting it. I'm going to have to respect the demand zone and the neckline. And I am expecting some green today. If we do end up coming up, breaking through, I'm just going to throw out a couple of scenarios. This is what I'm hoping for. I do hope we come back and test this supply zone up here. And I'll definitely be loading up shorts once again. And maybe we come up and fill the gap. We never filled the gap here at this 408.3. If we do fill the gap there, I'll add into my shorts. And then, of course, I'll have to watch the stop loss with this price action up here. But for now, once we come up into this zone over here, I'll look to grab some shorts and then see if we can come back and retest and break through this. Now, if today we get something where we're slightly gapping up, which is crazy. No one expected that. But if we do blow through, the big level I'd be watching out for below here would probably be around, let's see what we got. This 386 level. You can see the price action up here on this curl. And then once we broke out, tested that, what was once a supply zone, break, hook, and go off this level. So 386 will be my target if we do come through this on the daily time frame. But for now, let's just pray and hope we come back up. I got to load up on shorts, man. This thing cannot go without me. I'm going to be upset if this thing. Market mayhem. You know what's
I
up.
feel you. Yeah, I feel
Yeah,
you. I'm
yeah.
on the exact same boat. I'm looking for a little bit of upside, but not because I'm bullish, but because I want better prices to reload on some of these shorts.
Exactly. This is the way. That'll be it, Hondo. Thank you.
All right, awesome. Thank you, Mo. Want to thank Markets and Mayhem for joining us. As always, it's a pleasure.
Thanks for having me, guys.
Thanks for coming on the show, man.
Yeah, it's a lot of fun.
Absolutely. All right, guys, that's going to do it for this morning show. That's going to do it for this week of Beat the Bell. We hope that you guys got the chance to join us. Looking into next week, there's a lot still on the table. As we mentioned earlier, the market has a lot to learn, and we'll be back next Monday talking about it at 8:30 a.m. Eastern Time. Thanks again for joining the show, guys, and we will catch you next week. Have a good one, everybody. Have a phenomenal weekend. Have a good trading day. Manage risk. Trade smart. Don't do anything dumb. It is a Friday. We'll catch you guys.